I want to welcome everyone to the video on contributed capital. We're going to cover stock, both common stock and preferred stock. And the difference between the two is every corporation has to have common stock, whereas preferred stock is only sold by certain companies. You don't have to have preferred stock. But preferred stock has preference in the form of dividends, but may not have voting rights, so it's a little different classification of stock. But it does have preferences over common in certain areas. Okay. Then the other term we're going to look at is par value. Now the way we record this is this will be done for both preferred stock and common stock. Just change the names, but it's done this basically the same way. And the par value is an arbitrary number that the company chooses to record common stock at. And stocks do not have to have a par value. There can be no par value. But for the no par value, they may or may not have a stated value. So stated values and par values are done the same way, just change the name here. But that's just the way we record the common stock. And then everything else above par value will go into additional paid-in capital. So the main thing is to remember par value has nothing to do with market value whatsoever. It's just a way of recording common stock. Okay, so first we're going to do is sell it for cash. We're going to sell 1,000 shares of common stock, $2 par value at $25 a share. So we're going to sell it for cash, so we received cash. And we sold 1,000 shares times $25. Okay. Then the credits, we issued common stock. And we're going to put in there $2 par just because. And that's equal to 1,000 shares times the $2 par value. Then, like I said, the balance will go into additional paid in capital. And I'm going to put in common stock because we're going to have several different types of additional paid in capital. And that's going to be equal to 1,000 shares times the $25 minus the 2, which is the par value, or 23,000. Okay, like I said, if this was stated value, instead of $2 par value there, you'd have $2 stated value. But it's going to be done the same way. And if it was preferred stock, you'd have preferred stock there, and this would be PS instead of CS. Okay. For no par stock, okay, we would have cash again, and I'm not going to calculate it this time, but it's for the 25,000. And we would have common stock, no par, and that's for 25,000. Okay, and that's selling for cash. Now the other way stocks are issued is basically through subscriptions. Now for this one, we're going to do subscriptions receivable. We're going to receive subscriptions for 1,000 shares of $2 par value stock, and again the market price is $25. But this time it's going to require a $5 down payment. So for the $5 down payment, is be cash is equal to 1,000 times 5, and then we would have subscriptions receivable. And again, sometimes I will put CS behind it because it's common stock, because you have more than one subscriptions, and that's equal to 1,000 shares times the 25 minus the 5, or $20,000. Now this will be common stock subscribed. And that will be equal to the 1,000 shares times the $2. So common stock subscribed is recorded at par value. It's not common stock yet because it hasn't been paid for. Okay, it's just subscriptions. But the balance will go into the additional paid in capital account. Now I'm going to start using an acronym for this in a little bit. But right now I'll still type it out. common stock. And this is equal to the 1,000 shares times, again, the 25 minus the 2, or 23,000. Okay, so you notice this is going to the common stock subscribed. Common stock subscribed will go into the balance sheet stockholders' equity section if that's the end of the year. And it'll go in for $2,000, just like common stock. When you receive the cash for the balance, you have cash of $20,000, and then you would credit subscriptions receivable. For common stock. Now you'd have a subsidiary just like this before, but just like you did before. Okay, subscriptions receivable. Now you're not done yet because you have to issue the stock. So you have to debit common stock subscribed. Yeah, don't read common stock. And that is for $2,000, and you credit common stock for $2,000. Okay, and that's to issue the stock. So don't forget, when you receive the cash, you have to issue the stock. Okay, now sometimes it's bundled. So ABC Corporation sold 200 bundles of 3 shares of $2 par common stock and $50 of par stock $50 preferred stock for $95 per bundle. Separately, common stock was selling for $15 per share and the preferred was selling for $75 per share. Okay, so the first thing we really need to do is go down here to the bottom. Well, we can do this one. This is the cash, right? We're going to sell it for cash, and we sold the 200 bundles times $95. So we sold it for $19,000. Okay. Now, if they were sold separately, we'd have $15 per share, 200 bundles at 3 shares per bundle. Okay, so we multiply all that out. So we'd have 15 times the 200 times the 3. So that's what we receive for the common stock. For the preferred stock, it was selling for $75 a share, 200 times 1 share, or 15,000, for a total of $24,000. Okay. So down here, I got to get rid of the 24,000. The 19,000 is what we have here, times the 9,000 divided by the 24. So we're allocating that 19,000 between the two. It's kind of like, okay, so we have equal 19,000, which is the cash we received, times 9,000 divided by the 24, which is the percent of total that it has, or 71.25. For the preferred stock, we'd have the 19,000 times, it contributes 15,000 out of the total of 24,000. Okay, so now we're ready for the journal entries. So we have common stock, but remember this is $2 par. Okay, so it's equal to, we have 200 bundles times 3 shares times $2, which is $1,200. Then the difference will go into additional paid-in capital, common stock. APEC is additional paid-in capital for the common stock, and that's going to be equal to, well, it contributed a total of 9,000 minus the 1,200 we already have recorded, so it would be $7,800. Okay. No, sorry, wrong numbers. Let's try this again. Equal. It was the 71.25 that we have, that we said is allocated, minus the 1,200. See, I grabbed the wrong set of numbers. 59.25. Okay. Then we have preferred stock. And you can do the same thing. that was for $50 par. Okay, and that's going to be equal to the 200 shares times the $50. Holds the same thing, $10,000. And then we have additional paid in capital for the preferred stock, and that's going to be equal what we allocated to it, which is $11,875 minus the $10,000. So it's $1,875. Okay. Then we have, if the $15 common stock is known, then do the following entry. So if we don't know everything here, okay, for instance, all we know on this example, all we know is that the $15. So up here, we don't know about the $75 per share. Okay, so again, we would do cash would be, of course, for the $19,000. That doesn't change. Down here, though, for common stock, we would have, this is the only one we know of, so we'd have the 200 times the 3 shares times the $15. So 9,000 of that will be contributed to common stock because we don't know the value of the preferred stock. So we'd have common stock $2 par, and that would be equal to the 200 times the 3 times the 2, or 1,200, and we have additional paid in capital, common stock, and that will be for the 9,000 minus the 1,200, or 7,800, and then we have preferred stock $50 par. That's equal to the 200 times the 50 times the 1, or 10,000. And if we add these up, you notice that we equal $19,000. So we're done because this is going to be 0 here because we don't have any additional paid in capital. Okay. So you always have that has to equal at least par value. Okay. Next we have non-monetary exchange. And I think I'll stop there.